Hello. Let's talk about the general ledger and why accountants post general journals to the general ledger. The 9-step accounting cycle is a series of steps performed during each accounting period to classify, record, and summarize data for a business, and then to produce needed financial information. The first step in the 9-step accounting cycle is to analyze business transactions. We did that in chapters 2 and 3. The second step in the accounting cycle is to prepare a record of business transactions, which we completed when we prepared journal entries. Our third step is to post the journal entries to the general ledger. What is the general ledger? The general ledger is a sort of master file of all transactions in the accounting system. When you look at a company's general ledger, you will be able to go back many, many years and find transactions about the business. It's a permanent, classified record of all accounts used in the firm's operation. That is why it's often called the record of final entry. But before we can use the general ledger, we need a general journal entry. So that's the first part. The process of recording the journal into the general ledger is called posting. Our textbook references general ledger forms, but there aren't really many businesses that still use ledger forms, binders, or books. Even small businesses typically use an electronic accounting system such as QuickBooks. Why? Well, it makes many manual, tedious functions of accounting much easier. In addition, records can be stored digitally and are safe from inadvertent destruction. The process of posting a journal entry to the general ledger includes these 5 steps. On the ledger form, enter the date of the transaction and enter a description of the entry if necessary. Enter the general journal page. Enter the debit amount in the debit column or the credit amount in the credit column. Compute the new balance, and then on the general journal, enter the ledger account number in the posting reference column. This process is really automated in most companies. Let's look at the first transaction for Eli's Consulting, where Trade and Eli deposited $100,000 into the company's business bank account. In the general journal entry, we recorded this business transaction by debiting cash and crediting Trade and Eli capital for $100,000. The general journal records transactions in chronological order in which the transactions occur, but now we want to have a permanent record of the transaction by account. So our first step is to pull up the account cash and write the date of the transaction in the date column and enter a description. In the posting reference column, we'll write the page number on which the general journal was recorded and write the debit of $100,000 into the debit column. Next, we'll calculate the balance of the account. This was the first transaction for Eli's Consulting, therefore, there's no prior balance for the bank account. Our next step is to post the credit of our journal entry to the Trade and Eli capital account. We follow the same steps. Enter the date, enter the posting reference, and then the credit amount of $100,000, and we'll calculate the balance. Our last step is to enter the posting reference on the general journal, which is the account number of the account that the general journal was posted to. Let's look at the second transaction for Eli's Consulting, where Eli's Consulting Services issued check 1001 for $5,000 to purchase a computer and other equipment. In the general journal entry, we recorded this business transaction by debiting equipment and crediting cash for $5,000. Our first step is to now pull the account equipment and write the date of the transaction into the date column and enter a description. In the posting reference column, we'll write the page number on which the general journal was recorded and write the debit of $5,000 into the debit column. Next, we'll calculate the balance of the account. Our next step is then to post the credit of our journal entry to the cash account. We follow the same steps. Enter the date, enter the posting reference, and then the credit amount of $5,000 and calculate the balance. Our last step is to enter the posting reference on the general journal, which is the account number of the account that the general journal was posted to. What we have here is Eli's Consulting General Ledger. And we can quickly see in each account what we've recorded, the date and amount, and the balance in the account. Our bank account had 10 transactions, and the bank balance is $111,350. In the accounts receivable account 111, we can see that we had credit sales of $11,000, but that currently clients owe Eli's Consulting $5,000. The account supplies shows a balance of $1,500, and the prepaid rent account number 137 shows $8,000. In the general ledger, the balance sheet accounts appear first and are followed by the income statement accounts. The typical order is assets, liabilities, owner's equity, revenue, and expenses. This arrangement speeds the preparation of the trial balance and the financial statements. And most companies follow this methodology. The account equipment shows that $11,000 of equipment was purchased, and the accounts payable account shows that Eli's Consulting owes vendors $3,500. The capital account shows $100,000 and the drawing account $5,000. The fees income account shows $47,000 in revenue, and Eli's Consulting had only 2 expenses in the general ledger. Salaries expense for $8,000 and utility expenses for $650. In our example, we only have a few columns in our general ledger accounts. The bigger the company, though, the more information is tracked in the general ledger. For instance, additional columns might be for department, project, location, or legal entity if the company has multiple subsidiaries. Here's an example that is very similar to your homework for Chapter 4. Here we have selected transactions of the Zillow Consulting Services Company. The first transaction is the starting investment of Martin Zillow, who invested $76,800 in cash to start the firm. We first analyzed the transaction by deciding what resources or obligations of the company changed. In this case, the business's cash increased, and the obligation to Martin Zillow increased as well. Now we need to classify cash and the obligation to Martin Zillow. Cash is an asset, and assets increase with debits. Therefore, we need to debit cash. The obligation to Martin Zillow is an obligation to the owner and is part of owner's equity, which increases with credits. Therefore, we need to credit Martin Zillow capital. Let's look at the next transaction. Zillow Consulting purchased office equipment on credit for $7,050. How do we know that the company purchased on credit? It states that the amount is payable in 30 days. So with this transaction, let's first understand what resources or obligations of the company changed. The company now has more office equipment, and office equipment is considered an asset. assets increase with debits. Therefore, we debit the equipment account. The company now also has more obligations. It owes $7,050 to Furniture Expo. We call that an accounts payable, which is an obligation or liability. Liabilities increase with credits, and therefore we need to record a credit to accounts payable. Now let's look at the third transaction. Zillow Consulting purchased an automobile for $32,900. So for this transaction, let's understand what resources or obligations of the company changed. The company now has an automobile, which is considered an asset. Assets increase with debits. Therefore, we debit the automobile account. The company now has less cash, though. Cash is also an asset, and assets increase with debits and decrease with credits. That means we have to credit cash. In this next transaction, Zillow Consulting purchased supplies for $855. The company now has more supplies, which are considered assets. Assets increase with debits, therefore we debit the supplies account. The company now has also less cash. Cash is an asset, and assets increase with debits and decrease with credits. That means we have to credit cash. On September 5th, Zillow Consulting returned damaged supplies for $215 for a cash refund. The company now has more cash. Cash is an asset, and assets increase with debits. That's why we have to debit cash. The company now has less supplies, which are considered assets. Assets increase with debits and decrease with credits. That means we have to credit supplies. On September 6, Zillow Consulting issued check 1003 for $4,050 to Furniture Expo. The company now has less obligations. We previously recorded the obligation as an accounts payable, and now that accounts payable decreased. Liabilities increase with credits and decrease with debits. So that means that we have to debit accounts payable. The company now has less cash. Cash is an asset. Assets decrease with credits, and therefore we have to credit cash. On September 7th, Martin Zillow withdrew $6,900 for personal expenses. The company now has less obligations to the owner of the business. We previously recorded the obligation as owner's equity, and now owner's equity decreased. Owner's equity increases with credits and decreases with debits. Personal withdrawals, though, are tracked in a separate account from the initial capital that Martin contributed. We use the drawing account to track those withdrawals and will debit the account for $6,900. Now the company also has less cash. Cash is an asset and decreases with credits. Therefore, we have to credit cash. On September 8th, the company issued check 1004 to pay the rent for September. The company now has less cash. Cash is an asset and decreases with credits. Therefore, we have to credit cash. The company now has more resources, though, since rent is considered prepaid expenses until fully used up. Prepaid rent is an asset, and assets increase with debits. That means we have to debit prepaid cash, prepaid rent. On September 9th, the company performed services for $8,865 in cash. The company now has more cash. Cash is an asset, and assets increase with debits. Therefore, we have to debit cash. The company also now has additional revenue. Revenue increases with credits, which means that we have to credit fees income. Lastly, on September 10th, the company paid the telephone bill for $285, which decreased cash and results in a credit to cash, and it increased expenses, which means we have to debit telephone expenses. Each transaction is now entered as a journal entry. For instance, for the first journal entry, we write the date and then cash and a debit for $77,600. On the next line, we slightly indent and write Martin Zillow Capital and a credit of $77,600. We repeat the process for each transaction until all journal entries are complete. Our last step is now to post each journal entry to the general ledger. For instance, to post the first transaction, we go to the cash account, we enter the date, and we enter the debit of $76,200. Then we calculate the new balance. Next, we'll go to the Martin Zillow Capital account and we enter the date, and then we enter the credit of $76,200 and calculate the new balance. To post the second transaction, we go to the equipment account, we enter the date, and we enter the debit of $6,450. Then we calculate the new balance. Next, we'll go to the accounts payable account and we enter the date, enter the credit of $6,450, and calculate the new balance. That's it for this video. I hope this lecture and the additional example was helpful.